Hello and welcome to our next Reagan Roundtable update for Q1 of 2021. We'll go through here and we'll introduce our panel. I'm Bob Teska with YearEnd CPA CPAs.
Kevin Moteyunas, Commercial Risk Manager with the Reagan Companies.
Jim.mcelhannon, Commercial Risk Manager, Reagan Companies.
And I'm Fran Lowther, Bond Manager here at Reagan.
All right. So, as usual here, we're going to give you a quick update from the accounting world, a little bit from the bonding world, and a little bit from the insurance world. I think we'll start off with saying none of us picked the right Super Bowl champions.
No.
Yeah.
So, close.
Taylor gets to keep all of our winnings. All right. So, do we have anything to make a pick on here?
I was thinking about that as we were coming in, and I don't know.
No, we're unprepared.
I'm going to unfortunately say that SU will not make the tournament.
After the Duke game, I would totally agree. Embarrassing.
All right. So to slide right into some boring accounting stuff here, we're going to talk a little bit about the employee retention credit. This is something that came out same time that PPP-1 did, back in last April, May, when the pandemic was really ramping up, and it's something that did not get a lot of play, certainly not as much as PPP did. Reason being, when it first came out, if you got the PPP loans, you could not apply for the employee retention credit. PPP was way more beneficial, so basically, nobody was going for this. With the recent legislation that came out allowing you to go for a second round of PPP, they amended the rules relating to the employee retention credit, making it now available even if you got a PPP loan, which let you go back and adjust what you would have done in 2020 retroactively. So there's going to be real broad strokes. It is relatively complex, and to get the details, you should reach out to your CPA. But it is a credit that you're going to claim on your federal form 941 when you're filing your payroll taxes. If you are eligible to claim this for 2020, which obviously is closed, you would have to amend that 941, which you got some time. You got like 3 years to do that, so there's plenty of time to do that. And it's a credit based on wages paid through a specified period, March 20th through June of 2021. The 2020 credit, they're bifurcated. The 2020 credit is different than the 2021 credit. The 2020 credit is good for 50% of wages up to a max credit of $5,000 per employee based off of 10,000 of wages. So basically, you look at your employees, you got 10,000 of wages, you get a 50% credit, so it's $5,000 bucks. The 2021 credit is up to a 70% credit on those same 10,000 of wages per quarter. So it could be a $7,000 credit per employee per quarter in 2021. So the 2021 version is actually much more beneficial.
Wow. Significantly.
Yeah, so there is interplay with PPP here. So the wages that you use to claim for your PPP forgiveness can't be used to support the employee retention credit. So it makes filing your forgiveness application for your PPP loan a little more challenging, and you got to put some planning into it. And you might have to use some of those other available expenditures like rent, mortgage interest, and stuff like that to make your application work with PPP and sell enough wages for the ERC. To qualify for the 2020 employee retention credit, there's two ways. If you were subject to a government shutdown, because of the shutdown you were unable to work, that would allow you to qualify for this. Or if you had a 50% reduction in sales, comparing a quarter of 2020 to the same quarter in 2019. It is still a pretty big hurdle, but I have to be honest, I'm talking to my clients, quite a few qualify for this for one reason or another. So that's challenging in 2020. In 2021, it is a lot easier to qualify. You only need a 20% reduction in sales comparing to the quarter of 2021 to that same quarter in 2019. So I anticipate more people qualifying for the 2021 credit, which is actually more beneficial to you at $7,000 per employee per quarter. So,
yeah, it seems like a lot of people, when you compare that back to 2019, which was a really robust year for most people, I would think most contractors are going to be able to take advantage of that.
Yeah. Again, it is a little complex. This is very high level, so reach out to your accountant, your CPA, to get some guidance on this. You're going to have to work with your payroll company a little bit to actually get the credit, because again, the credit comes from filing of your payroll taxes on your 941. But it's beneficial. It's out there. You just got to dig into it a little bit.
Worth exploring.
Yeah. All right. So now we're going to switch gears and move over to Fran with some really positive stuff in the bonding world.
Yeah, we got nothing but positivity in the insurance and bonding world. Unfortunately, that's the world we're in these days. But so we just thought we'd touch upon a couple things just to keep in mind as we're entering into this spring. Hopefully, we're here shortly. The spring will be here, bidding season. So. From a bonding perspective, the year-end CPA prepared financial statements are very important in the world from a bonding perspective. Surety credit is extended by bonding companies very much primarily on that one day and time of your year. They're going to base most of your bond capacity decisions on that working capital net worth calculation and the analysis that they complete on that 12/31 statement, or whatever the fiscal year end statement. This year, I'm just urging everyone to really put the time and effort in early in this year to get the paperwork and things that you need to do in order to get your statement out the door, cooperating with your CPA in order to get this done. Because the bonding companies, I say it all the time, they're inherently, conservative. They're not the entrepreneurial people that contractors and business owners are. They are much more conservative from a decision-making standpoint. So they're looking at 2020 from the lens of COVID-19, the anticipated material supply problems, the slow pay problems we're seeing often with owners, public owners, the owner's tendency, again, to draw out the payments, leading to cash flow problems. So the surety companies are looking for these statements in a much more timely manner. The idea is the desire for the bonding companies to have it 90 to 120 days is typically the goal. But in past years, the bonding companies have been very patient, especially pre-COVID. I don't expect the bonding companies to be as patient this year because they really want to make sure that all their bond clients are standing on solid ground from a financial perspective, going into taking on new capacity. So that's my cautionary tale in terms of fiscal year-end statements. Just make sure you're doing all you can to communicate with your bonding company, like we always talk about, but to do it in a much more timely manner this year. So just put that priority on that part of your business here in the first quarter of the fiscal year. The second thing we want to talk about is the treatment of PPP forgiveness, and this is something I'll bring Bob in and talk to you to a little bit to an extent concerning how it will be treated, because I think many contractors began the forgiveness process at the end of 2020, but most have not heard before 12/31. I mean, I'm assuming here a majority of the contractors will have a 12/31 year-end financial statement, so I keep saying year-end, but that year-end statement determines when and what Bob can do from a reporting standpoint, from a forgiveness standpoint. So I want to just give us today the perspective from the underwriting world and what the bonding company will do and interpret what Bob is able to do from a reporting standpoint. So, the directives that the bonding companies are receiving, the underwriters are, they want to be consistent in their treatment here. So they consider a PPP loan like they would any other loan with a maturity date and a certain portion of that loan due within the 12 months. So they'll treat that current portion of that debt as a current liability and the long-term portion of the debt as a long-term liability. We'll just throw out some examples, Bob. If you have a contractor who has applied for forgiveness before 12/31, but has not received that official notice of forgiveness before 12/31, how would you treat that in your statement?
We've got a couple of options there, Fran. If subsequent to year end, so subsequent to 12/31, they did receive forgiveness, we would record the, again, we're following accounting guidance available to us by the AICPA and FASB. We would record the forgiveness as if it had happened and then disclose that it happened subsequent to year end. So the loan would come off the books, it would be recorded below the line as other income, and then we would disclose in the financial, hey, subsequent to year end, the loan was forgiven and it was reported as other income. Has the loan not been forgiven by the time that we issue the financial statement, we would leave it as a liability on the books. However, we're going to show the whole thing as long-term. So there's not going to be a current portion that would affect working capital, which is what affects the bonding capacity. Obviously, the surety can adjust that. But and the reason being there, a current liability by definition is a liability that's going to be satisfied with cash over the next 12 months. If management of the company believes that they've met all the criteria to have the loan forgiven, whenever that's going to be, then that doesn't rise to the definition of it being a current liability, so no portion of that would show up as a current liability, so we would report it all as a long-term liability in the financial, and it just, that's where it would show up as a long-term liability.
Okay, so that the communication part, again, incumbent on us as a bond producer, you as a CPA, is to explain that to the bonding company, because bonding companies will do two sets of analysis: the as-given analysis, what Bob just described, and that as-allowed analysis that the bonding companies use to determine what is that working capital calculation and how much capacity are we willing to extend. So that will play a significant. Their ability for the underwriter to understand the likelihood of forgiveness is important. Again, considering we're dealing with conservative people, we have to make sure that we communicate that. So they may, in that as given versus allowed calculation, may treat the loan differently than you will, than Bob would, and most CPAs will. And it may impact working capital and net worth to a certain degree, because if it's a 5-year loan, 20% of that current portion will be in the current liabilities. If it's a 2-year payback period, it's 50%. So the bonding companies, just from an underwriting standpoint, they're going to take into consideration the loan as a very positive thing, even if they're including this as a liability. They're going to use that working capital to support future approvals. It's going to be in the back of their mind. Bonding companies are not going to want to base an entire case on the likelihood of the PPP loan being forgiven, but it is a very positive part of their analysis. So if you have a balance sheet that is strong, and the PPP just makes it stronger, so much better for the bonding company and the bonding company's eyes. Where you may get a little bit pushback on how they treat and how they feel about it is when you have a marginal working capital case based on the capacity. They may not be overly aggressive. You may not get 100% of the value of that PP loan to generate an approval for a very large project. So all in all, I think that the bonding companies are going to treat this as a very positive thing, but you may not get the full bang of your buck until you're able to provide that documentation, either a screen grab off of the bank company's website that shows that zero loan balance. That's the documentation they're going to be looking for, because I think the SBA isn't going to give a formal paperwork in terms of the approval of anything under $2 million?
Actually, most of my clients, I got a letter
From the SBA directly? Or from the bank?
Might be from the bank showing the actual payoff.
Right. So I think it's just from the bank. So that's where you want to provide that to the bonding company. So all in all, again, the PPP program has been very successful in doing what it was intended to do, and the bonding companies have treated it like a very positive thing, but just a little bit more reserved in providing full value for that loan until it really gets repaid. So just a word of caution, just to make sure you're willing and able to provide that documentation as quickly as possible. And the final thing we wanted to talk about is just touch base on, and I am not an attorney, but this is something that we've been seeing it from a project underwriting perspective quite a bit, is instances where owners or GCs have very much slanted, added, deleted clauses in their contracts, thinking about COVID-19, potential delays, subsequent damages. These clauses that protect the owner have been either created, increase the robustness of that language, or all in all just completely slanted these contracts in the favor of the owner. So biggest thing I see is the consequential damages clauses, where contractors are waiving their rights against the owner, at the same time allowing for they are at risk of paying unlimited consequential damages based on delays. So the contractors are giving up their rights by signing these contracts to go back to the owner and recoup additional costs associated with large delays or long delays. Delay of time clauses, they're unable to apply for extensions of time based on COVID-19 delays. Warranty clauses where the warranty period does not start until the final payment is made by the owner. So, that could stretch on for forever, based on if you have some whatever issue with the owner, you may not get into that warranty period for 2 or 3 years after that issue is resolved. So there's a lot of things to consider here. Like I said, I don't want to get into real specifics and technicality or technical language because I'm not an attorney, but it's something to keep an eye out for and be mindful when you're looking at these contracts. I've actually seen contracts where the bid documents are a standard AIA document, and then when the contract gets awarded and it's sent to the contractor, it's an entirely different contract with all kinds of different clauses. So just be very mindful that those things are happening, and you'll have to take a decision on job sizes and what your appetite for risk is. But at least be mindful and open-eyed when you enter into these contracts.
All right. Ooh, now we're moving on to the wonderful world of OSHA.
Yeah, I can tell you, Kevin and I can't wait to have one of these roundtables where we can talk about something positive and uplifting. Not much has changed from the insurance marketplace, and we're not going to focus on that in this quarter. But the same messages we've said previously still applies. Be prepared. Increases are continuing. The market continues to harden, and you should be prepared for that. But what we want to talk about today is a little bit about the changes with OSHA under the Biden administration. This is going to look very similar to what it looked like under the Obama administration. And what that means is compliance by shaming. Any of us that were around in that time frame can remember they had a very robust practice of regulation by shaming. So they're putting all the violations and all the dirt in the newspaper and trying to force you to comply based on that pressure that creates. So you're going to see a much stricter OSHA under this administration. So be prepared for that. Which leads us right into our first point. Almost immediately an executive order was issued. It was issued on January 21st, giving OSHA a greater role in reducing the spread of COVID-19 in the workplace. There's new recommendations that appear to be part of an overall standard that could come as early as March 15th and end up in the Emergency Temporary Standard, or the ETS, and Kevin's going to talk about those. So again, this is just a way for them to come in the door and start looking around and looking for other areas. So it's really important to listen to what Kevin has to say here.
Yeah, you're exactly right, Jim. And it's important to understand that the latest guidance that OSHA just released, it is not mandatory. However, it does provide some insight into the direction that the agency is planning to move. So these recommendations here, while they're not mandatory, there's a high likelihood that they are going to be required down the road as part of this ETS standard. So the first one is a communication process and training to allow employees an anonymous reporting mechanism to report COVID-19 related concerns. The second one is providing all workers with face coverings, making COVID vaccines available at no cost to all eligible employees, and providing information and training regarding the benefits and safety of the vaccines, and then not distinguishing between workers that are vaccinated or not. And what that means is if you are vaccinated, you still have to follow all the rules in place. So, again, a lot of this stuff we've been doing already, but this is kind of forcing us to formalize this a little bit more and have these policies in place. So I think in general, employers should look to review the COVID-19 protocols they have in place now and make the updates to line up with the new guidance that's coming out here. And then once those updates are made, kind of comes the implementation aspect of it. And the most effective programs engage workers and their union workers in the program's development, but also include a couple of key elements here, which is conducting a hazard assessment, identifying a combination of measures that limit the spread of COVID-19 in the workplace. And again, this is stuff we're already doing, but it's going to become more formalized now. Adopting measures to ensure that workers who are infected or potentially infected are separated and sent home from the workplace immediately. I think the biggest one is implementing protections from retaliation for workers who do report anonymous concerns to OSHA. And that's something that's now in writing that gives these whistleblowers an avenue to basically say, things aren't going the way that we feel they should be going. I don't feel safe. It's not a safe work environment. And retaliation is not acceptable in those whistleblower situations.
Yeah, one thing that I'll throw out too for any of those that are listening to this, we do have a checklist, a COVID-19 vaccine workplace planning checklist, which takes you through the vaccine planning, policy development, the distribution of the planning, employee communication, vaccine communication topics, and if you have been closed, how to reopen your workplace. So this is something that is going to be a reality very, very soon, and being prepared is going to be a necessity for those for all those involved. If you want to go to the next one, Bob. Yeah, so going kind of back to what we let in with under the Biden administration, there is going to be a lot of change. Some statistical things that we want to point out to you that are going to change, and they're going to change rapidly, is the White House has vowed to increase the number of inspectors, which are currently at a historically low number. In fact, OSHA is now at the lowest number it has been in its 48 or 50-year history, which is kind of surprising.
Yeah, I mean, as you can see, in 1982, they had just over 1,000 compliance officers. In 2010, kind of remained the same. 2016, that started to drop down a little bit, down to 952, and then January 1st, 2019, they were at their lowest level in about 40 years with 875 compliance officers. And everything that we're hearing in the direction OSHA is looking to take is that they're looking to ramp that number of compliance officers back up, which ultimately, lends itself to more site visits and an increase in citations and fines.
Yeah, it's no secret under a Democrat in office, they utilize OSHA as a revenue source. So, you can fully expect that, that relaxed inspection that you've experienced over the last 4 years, if you've had that experience of having an inspection, will be much different in 2021 and going forward. So be prepared. We talk about this, I think, each one of our meetings. Polish up your policies, your internal policies and procedures. Make sure that you're prepared. February 1st, you need to have your OSHA logs posted. Make sure that your logs are posted on all your your job sites. Do everything you can in-house to protect yourself. So if you do have the unfortunate experience of an inspection, that you've done everything you can control to make that process go as smoothly as possible. One thing that we know for a fact is if you don't have your house in order, that inspection is going to intensify immediately, and the fines are just going to follow suit. So,
yeah, I think the only thing I'd add to that is, as we're talking about this temporary standard that OSHA's issued, we're hitting the high points right now, and if we really want to dive into this could probably be an hour-long webinar. But as far as the resources go and any questions that any of you guys may have, feel free to reach out to Bob, and he can put you guys in touch with us, because as an agency, Reagan has all of these resources available and at our fingertips, and instead of trying to reinvent the wheel, we've got them ready to go. So.
Or their contact information was on that first slide. You can just call them.
I was saying, you don't want to be inundated with insurance calls, do you, Bob? But, yeah, so, we appreciate the, getting back together. I'm so much looking forward to hopefully the second quarter in the next edition. We can have something a little more upbeat and some positive stuff to talk about. But
I'm not going to invite Kevin and Jim back if they're not positive next quarter.
We'll dig to find something.
Yeah, anecdotally, this first quarter has started off much better than I thought it would be from a bid activity level. It seems to be more work out there than anticipated. Still, the bidders lists are long. Competition is still pretty great.
Yeah.
But there does seem to be some work. So hopefully that flow of work will continue into the second and third quarters.
All right. Well, thank you guys for coming in. Thanks everyone for listening, and we will see you next quarter.